So the topic for today is value investing back in vogue. And clearly the performance of value strategies over the last 6 months has caught a lot of market participants by surprise. For the next 25 minutes or so, what I'd like to do is just investigate the relationship between value and growth, some of the drivers, and as an allocator of capital, where best one would want to put their capital with some kind of insurance policy. So value versus growth. Clearly, the last decade has been a great performer for growth strategies. And as a value investor, as what I am, it's been a difficult time. We've tended to underperform. The momentum, everything has really been in favor of growth. But if we just go back to the past, that hasn't necessarily all been the case. And in this graph, what I show you is the relationship between growth and value over a period of about 50 years. So going back as far back as 1974, where the line tends to tend down, that is when value outperforms growth. And likewise, when it starts ticking up, that is when growth outperforms value. In November, things changed. And over the last 6 months, value as a strategy has certainly fought back quite well, as indicated by the red line. And let's investigate a little bit more as to why this has happened. Well, clearly the main reason for this has been a change in perception in terms of the success over vaccines and getting to a new normal in the world. And what I really want to illustrate in this graph is the fact that by September 2021, most of the developed world, that being UK, US, Europe, Canada, Australia, and Japan, will have had at least 60 to 70% of their adult population vaccinated with at least one dose. So all I'm really trying to extrapolate from this graph is the vaccine progress has been very good. And as a result of that, we can expect that going forward, although COVID is going to be around for a long time, the devastating impact that it had on the world in terms of both healthcare and environmentally and economically, things are likely to look a little bit more normal in the next few years. But interestingly, as we've moved towards an environment from November onwards, some of the worst performing sectors of the first quarter or half of 2020 have now become the best performing. So here we have USA GDP change year on year. And you can see the big fall that happens from April onward as the economies are basically shut down. And then we see the dead cat bounce, the big pickup from, again, the end of 2020 to date. And that has obviously led to a massive rotation of companies that couldn't operate in an environment to companies that certainly can. Alongside that, you've had huge stimulus. You've had both fiscal and monetary stimulus from all across the board. But this leads to the next question, and that is the big elephant in the room, inflation. And here we see some of the blurbs. Inflation is here and hotter than it looks. Why? It's time to worry. Google searches in the last couple of weeks are worried about inflation. And one needs to be a little bit concerned about inflation because, as we know, inflation generally is not good for equity markets. And this plays out probably best in interest rates. So when one looks to get a feed of where interest rates are going to be or where inflation is going to be over the next 10 years, it's good to look where the actual market is pricing the US 10-year bond. But there you see between December and February 2021, a massive spike. In fact, a movement from 0.9 to 1.75, which has really scared some of the growth investors. The Fed, however, has turned a little bit of a blind eye. And the Fed's view is that this is relatively transitory. If you sit around and wait for this to normalize, the demand-supply balance will actually mean revert and we'll get back to some kind of normality. And as far as the Fed's concerned, they're looking probably at one of the more important issues, which is the employment rate. And their view is that the employment rate in the US is still very, very comfortably below par. In fact, until we get to a point where the labor force is back to levels as we saw in Clinton era, then you get both participation of the labor force and wage inflation. And their view is we're still a long way away from that. The market doesn't like shocks. And what's more, depending on what strategy you're involved in, you will either get more or less protection being in the equity markets. And this is an interesting fact. The worst 3 decades for value stocks relative to growth were all 3 decades with the lowest annual inflation. And those periods were 1930 to 40, 1950 to 60, and 2010 to 2020. So in a low inflation environment, obviously growth stocks outperform value. And this is the crux of the matter. If you look at the relationship between value and growth in the last few months, it's been extraordinary to see how correlated growth versus value has been relative to the 10-year bond yield. So again, if you just focus your attention a little bit to the black line, this is the line that I showed you earlier in the presentation, where the 10-year went from 0.9 in December to 1.75. If you look at the relationship between value and growth, you can see, as we see a blue spike there at the same period, that's where value outperforms growth. And likewise, it's kind of just flatlined as the market's getting a little bit more comfortable to what direction interest rates are likely to go and if there is going to be inflation. But there's something more at play here. The market is expensive. And as growth investors have lost a little bit of money in the last few months, they've really blamed it on things like inflation. But as Batman says, no, it's not inflation, stupid. It's because your stocks are overvalued. So yes, the trend line between 2016 to around 2020 was pretty upward, as we'd expect, 45-degree, and we can get that. Growth is a superior, arguably, strategy to value, and some of the companies in there, particularly the FANGs, are great businesses. But you see this massive spike from 2020 to around November, where there's been this massive outperformance of growth versus value, and then this retracement. And the question is, how much further has this rotation got to go? And all I've tried to do is go back to some kind of mean reversion. I'm not even saying that value is going to outperform growth and go back to a period as we saw prior to 2000. In fact, all I say is we get back to mean reversion, where we still have outperformance of growth versus value, but not to the same extent to where it was during a pandemic, which arguably was extraneous. It was very different, and the circumstances are likely to be different this time. And with that, I still think there's probably 30 to 50% left in the rotation. Timing-wise, it's obviously very difficult to say, but one must think that there's a lot more upside in value than in growth as we speak right now. And you can see that even with a value bias strategy, the Credo Global Equity Fund has actually managed to track and outperform the MSCI World at a time where value has been out of vogue. In an environment where we're going to have some kind of normalization, at the very least, of interest rates, or even worse, where we're going to have inflation, where the Fed has to step in a little bit early and we get a very rapid rise in interest rates. How do you protect your portfolio? And this is where we think you need to be positioned. Likewise, you want to be in sectors that are protected against inflation, defensive sectors like healthcare. We have about a 15% weighting in healthcare. Other companies you want to be in are companies that have pricing power and defensive companies. So in the consumer discretionary or the consumer staple sectors, you want companies like Imperial Tobacco or Diageo or Jose Cuervo. Likewise, in the industrial space, you want companies that can put the pricing onto the consumer. So cost plus pricing. Just a short word in terms of performance. This is the 3-year performance of the Credo Global Equity Fund versus our benchmark. And as I alluded to, we've actually outperformed the MSCI, particularly over the last few months, as the rotation into value continues to grow. Likewise, if you look at our correlation, we are very strongly correlated to a value index, but we massively outperformed the value index. And that's because of our tilt towards high quality businesses, but which we happen to buy very cheaply. Is it going to remain for the long term, or is it just transitory, as the Fed says? I think you need to hedge your bets. I think you need to take an insurance policy, and you certainly need to add a little bit more value into your portfolios.